Our next guest sees a debt ceiling as a catalyst for the S&P 500 to move down to 3,800, just about 4,000 right now. Evercore ISI's Julian Emanuel joins us at post 9. So what do you think is going to happen here exactly?
If you go back and you think about the contentiousness of politics right now, it seems very similar to us as the setup in 2011. And interestingly enough, leading into that original major debt ceiling debate, the market was almost dead silent for several months, same way it is now. And from our point of view, Washington politicians don't look at credit default swap prices. They don't look at T-bill yield spreads, both of which are flashing either yellow or red about what's to come. And we think they will look at stocks, but stocks need to go down first to get them to act.
They should look at CNBC because we mention CDS and T-bills every single morning at the top of this hour. And they can see that that panic is already starting to build in corners of the market. So you think stocks start paying attention when?
I think you can argue the last couple days, clearly the bank stress has been certainly a catalyst for the weakness we saw yesterday and the sort of back and forth that we're seeing today. But again, next week we get to May, and, you know, these sayings in the financial business are trite sometimes. But when you think about the debt ceiling catalyst, the concept of sell in May and walk away really starts to sort of ring true, particularly, again, given the stress in the banks.
What happens to the Treasury market if we default? Like in that moment, I'm just curious what your thoughts are. What's going to actually happen if it actually happens?
So we have had a lot of conversations on that, David, and we have done a lot of thinking on that. And I think the honest answer is no one really has a very firm idea. I think ultimately what will happen is if you had that kind of disruption, the reality of it hitting would cause that disruption to be very, very short, i.e. sort of like in line with the government closures that we've had from time to time, where there is more risk felt. So that would be redressed very quickly. But the fact is that the confidence loss that you would get from that, particularly with regard to international investors who have been looking for sources of diversification, gold among them in recent months, that would be a major issue.
Larry Summers was on the tape today, asked about the odds of a true technical default. He said 2 to 3%. Would you take the over or the under?
I think that's probably a good market because, again, the way this works, the way it has always worked, is that they cannot afford to let it happen. And hopefully Congress will come together somehow in some way to craft a solution. I'm sure that there will be a meeting in the minds, but again, not before there's volatility in asset markets.